on our website, we had the 2012 market update on there the entire year. I just talked about housing, and it looked like it was finally going to stop dropping in value. And we did get that. We actually ended up getting some price increases in housing, and it had a lot to do with the supply and demand factors out there in housing. So we kind of got that right for the most part. I guess it just depends on how you want to describe soft. We just didn't think it was going to continue to drop, but we ended up getting a little bit of an unexpected pickup. Interest rates, we said, were most likely going to remain low. We didn't see a pickup in rates this coming year, and that was our prediction. We didn't see them. So the prediction came right in on target. As a matter of fact, we saw a little bit of a decrease through the summer, and that's kind of reversed itself here the last couple of months. But through the summer, interest rates were definitely at some low points. We thought stocks looked relatively inexpensive if you compare them to earnings. So we thought, especially dividend-paying large company stocks, looked like there were some good opportunities in there. I mean, we were right on about that because the Dow Jones Industrial Average and the S&P were up quite a bit. As a matter of fact, the S&P for 2012 was up 16%. And so that was a nice return, including dividends, that we experienced in the stock market. Frankly, a little bit higher than we would have ever guessed. We were looking at maybe best case scenario half of that, but we'll take it. And we'll talk a little bit about why we had that big a run up in a slow economy marketplace. Then the last thing is the election year brings uncertainty. That was kind of my layup. I mean, every election year brings uncertainty, so we knew that one was going to be the case. But last year we did have a different level of uncertainty because we had the fiscal cliff. And if you look at the fiscal cliff, we talked about that in an October letter that we sent out as being a fairly big concern of ours, and we thought there'd be some sort of compromise reached, and we wouldn't go over the cliff. Well, there was compromise that was reached, and it was even more watered down than what we would have expected. But nevertheless, the markets kind of rallied here this year when the news was fairly apparent that we weren't going over the fiscal cliff, okay, which turned out to be very, frankly, just a little bit of a tax deal with no spending cuts addressed. Bottom line is, and this is our theme for every single year, is, we just need to be careful. We need to really make sure that if we're working with you on a strategy, that we're really keeping in mind what the strategy is. It doesn't matter too much that the S&P was up 16% or bonds were up 4%. What really matters is if what we're doing with you as clients, and if you're not a client, what we're doing potentially with you as a client is setting up a blueprint and a strategy to make sure that we're meeting your goals and meeting the needs that you have to try to drive your own personal financial security. So that was a recap. We did pretty well last year as far as overall in the market trends and everything else. So let's jump into 2013 and what we expect to have happen this year. Here's the agenda. We're going to talk about the economy, housing, inflation and interest rates, U.S. stock market, fixed income, bonds, and international stocks, and the marketplaces internationally. That's it. That's all we're going to cover. There's obviously a lot of content there. I'm being a little sarcastic, but we are going to cover it fairly quickly. So as Janet said, if you have any questions, feel free to bring those up, and they can either be typed up, I guess, or we'll open up the mics a little bit too so that people can ask them right through the system here. So here's GDP. This number actually is a little bit dated over on the right-hand side. It says a 3.1% growth rate. That was through the third quarter. We weren't able to get this updated in time for the numbers that just came out, which showed a fourth quarter contraction in the economy by 0.1%. So looking at it from an annual perspective, 2012, the economy grew by about 2.2%. Now, I will tell you, we don't think that this fourth quarter number of 0.1% is an indicator that we're going into a recession. Okay, if you look at here, these are recessionary time periods in these gray bars. We don't see that happening. What was going on in the fourth quarter is, frankly, businesses were very worried about the fiscal cliff, and they were worried about 2013 in general. So instead of building more inventory, they were selling out of inventory. And when you're selling out of inventory, your GDP is going to decrease because they are not manufacturing and building more widgets. Okay. The other thing that we had happen in the fourth quarter is something that has been talked about recently around the fiscal cliff issue and the debt ceiling and budget constraints is defense spending started to get cut last year, and that showed up in the fourth quarter numbers. Okay. So for this coming year, we're looking at slow growth. I'll recap all of this at the end, but we're going to continue with this slow growth approach, and we're looking specifically at saying that this 4% barrier is something we just don't see the economy growing past, and we're going to be probably more in the 2 to 3% range. Not recessionary, not robust, kind of what we had this past year. Slow growth doesn't mean, that the economy is inevitably going to sink, but we do know that recessions and expansion kind of go through cycles. And this is the same exact chart that I showed you guys a year ago. And this chart is just showing how long does the economy expand until it experiences a recession, until it shrinks. And if you look down at the bottom, the average expansion is 58 months since World War II. Now, since this is the same exact chart as what I showed last year, we have to add 12 months onto this 25 months down here in this red area where it says present. So it's 37 months of expansion, roughly, that we've had here in the United States. And since World War II, our average expansion has been about 58 months. So that would tell you we've got about 20 more months of expansion until you would kind of get worried that the cycles of recession and expansion might affect us. If you want to go all the way back to 1900, we got a 45-month number, so that only gives us about 8 months. But we think, frankly, that some of that data going back into the 1900s is irrelevant in today's world. So continued expansion on a slow basis is what we're expecting for this coming year. One thing that's helped us out this year, and I think will help us out next year as well, is vehicle sales have improved. So you see, again, the gray bars represent recessions, and so these gray bars are when you obviously see sales declines. Not quite as much in here, but if you look at the Great Recession, as the media like to call it, we had this huge drop in vehicle sales. Okay. Vehicle sales dropping like that is one of the reasons that GM filed for bankruptcy, and Chrysler was sold to the Italians, and the Ford leveraged up their balance sheets so much so that they were the only company that didn't have to take government funding to stay in business. And I think that still benefits them to this day, that people might be a little bit more Ford loyal just because of they took care of business themselves, if you will. But nevertheless, sales obviously tanked in 2009 and 8 and have come back up nice steadily. You'll see a blip in there right at the tail end of the recessionary gray bar. It's a little green pickup. And a lot of you might remember what that was caused by. And maybe you took advantage of it, but that was the government program that the administration put in at the time, cash for clunkers, which did drive up sales. But it obviously was only a temporary pickup, and then sales went back to their more normal market condition rates and have come up on their own because of market conditions. Okay. So that's good for the economy. Consumer spending has continued to increase over the years. And the blue line represents year-over-year change in consumer spending, and the green line represents the growth of overall consumer spending, or total consumer spending. So you can see, again, we did have a little bit of a hiccup in consumer spending on a total amount basis, but a big drop in year-over-year basis, where it actually decreased pretty substantially. We're now leveling off in this range, which is probably a healthy range. Consumers are doing a little bit of saving, and so we're not in those big years of spend like we had in 2005. But that's good for the economy that the consumer is out there spending and relatively confident with the economy and the overall marketplace. one reason they're probably confident is because, you know, a lot of individuals and households have a lot less debt now than they used to. And there's a couple of different reasons for this. One reason is they could have frankly walked away from their debt, okay, and that would have driven down your household debt service ratio. The other reason is probably the more prominent reason is interest rates have obviously dropped since 2006. So getting a mortgage or getting other low interest debt has really driven down this ratio. So that's good for the consumer. Less of a debt load allows them to save and or spend more, which should be good for the economy. And again, this is all within a relative, you know, strength as far as the economy. If we're not looking for robust economy growth, we're not going to see a huge amount of consumer spending. But the other thing that makes consumers feel good about themselves and therefore, again, makes them more likely they're going to spend money is their net worth. Okay, so you can see on this chart, there's a blue mountain chart, and that just shows total household net worth over the years. And you can see a huge acceleration of net worth, and then a big drop, and now a pickup again. Okay, that huge acceleration in the blue mountain chart there. A lot of that, look at from 2002 up to 2006. That's a tremendous amount of net worth growth. And predominantly, it came from housing and a strong stock market. It wasn't because personal incomes were going up and people are investing more. It's because housing market was very strong and the stock market was very strong. And obviously in 2008, the green line represents what happened in 2008, 2009 when housing prices dropped substantially and the stock market was down over 40%. Net worth dropped, and that's what caused this picture here of total net worth decreasing. Okay. As the stock market has improved over the last few years, 401k balances have moved back up, IRA balances have moved back up, and you see a nice pickup. And finally, home prices might start contributing to this as well. Okay. So the interesting thing about a net worth picture, what it does is it makes people feel more comfortable. It gives them the feeling of wealth. And so we call this the wealth effect. If you're retiring in 20 years, it really doesn't matter if your 401k plan took a big hit 1 year or not. It shouldn't make any difference if you go out to buy a new car or a new TV just because your 401k plan went down. But it does affect your feeling of how you are with your wealth, and that's what we call, again, that wealth effect. As far as unemployment is concerned, there was a number that was just released this morning, again, kind of looking pretty encouraging overall, that non-farm payrolls have been increasing. Okay, so these are for the most part, these are everything but farm-related industry jobs. It does include government jobs, but also includes private sector as well, and we've seen an increase in those. What's interesting, we saw an increase announced this morning, but we did see a slight tick up in the unemployment rates. 7.9% is where we are right now with unemployment. Last year I showed you a chart that was very similar to this one. And what this chart is showing you is that the initial claims for unemployment have been trending downward ever since they peaked back in 2009. Okay, so less people have been getting laid off and going and filing an initial claims for unemployment benefits. Okay, it's kind of a leading indicator of what the unemployment rate is going to do. So you see that as this drops, we started to see a drop in unemployment, moving down from almost 10% down to about 8, a hair under 8 at this point. And this will bounce around a little bit. It will go up and down. But we are not a big believer that this is going to have a substantial drop. We don't see it going down to 6% or 6.5% this coming year. We might get down into this range as companies need to do a little bit of hiring, but companies are being very, very cautious on bringing on additional expenses, and an expense that they can control is payroll. Okay? And so if we're in a slow economy, with unemployment that ranges maybe at 7.5%, maybe it could get to 7. That's going to be interlinked to what we think is going to happen to interest rates as well. And the strategy by corporate America to reduce their expenses has led to some phenomenal profits at the corporate level. And this chart really does illustrate that clearly for us. We saw a drop in, again, the gray bar here, we saw a drop in the Great Recession of corporate profits, but we've seen a remarkable increase in corporate profits. And the big reason we've seen such an increase goes back to the previous chart of we saw this big increase of unemployment. So corporations quickly laid off people and cut back capacity and utilization to drive up their profits. So their top line, their revenue growth might not have been increasing, or maybe even was decreasing slightly, but their bottom line growth, because of their cost cutting and their expense cutting, went up substantially. Now the key is, and we'll talk about this in a minute, is how long can that corporate profit picture still climb upward? So we'll talk about that in a little bit. But first, let's talk about housing, because housing is finally starting to improve. We don't think it's going to run rapid like it did back in 2004, where we saw these big increases in prices and very, very small supply of inventory on the market. So this was just basically a supply and demand imbalance. People were getting a lot of cheap money from the banks, a lot of easy money from the banks. That's what caused the delinquency rates later, bidding up house prices, whether it was here in the U.S., here in Minnesota, or throughout the U.S., Florida, Arizona, California. Everybody on a national basis saw this phenomenon pretty much occurring. Okay. And it was because the inventory had dried up. So this green line is basically showing the month's supply of homes on the marketplace. And you can see that once people stopped buying homes, all of this supply was sitting there. And so we saw this huge increase of supply of homes. And the buying dried up, the inventory went up, and we're finally seeing some nice downward trends in housing supplies. So the foreclosures that really drove up the markets in 2009 and 10 have been getting bought up. There's just less homes available out in the marketplace, and we're finally seeing that home prices started to swing upward, which reversed this big negative trend that we saw. This little issue right in here was, again, another government program where home prices got drove up for the short time, and that was the tax incentives and credits that people received for buying their first home. Okay. So we think this trend's going to continue. We think that there's going to be more home starts this year, and that trend has already started. Supply of existing homes have dried up. Builders are going back in and starting to build again. And so this, at the end here, this little tail up represents after 3 years of really no activity at all, after the big drop in housing starts, we're starting to finally see a little trend upward. Now we're not even close to this 1 million mark, but at the very least we're trending towards it and moving off the lows. Will we see these anytime soon? We're almost 2.25 million homes are being built a year. Yeah, probably not anytime in the near horizon, but if we can at least get up back towards average, that would be fantastic. So that's the housing. The housing market, I think that the worst of the housing market is over, and we'll wrap that part up again and when I do an overview here at the end. Now let's talk a little bit about what's going on inflation and interest rate wise, and draw a little picture for you here as well. And first of all, the inflation front that we thought might be a little bit of a concern for this coming year obviously never developed. We were looking at some trends last year where it looked like this blue line, which is the producer price index, and this green line were two different lines, CPI, PPI. And so we were anticipating that there would be some sort of growth in inflation because of this trend upward. But we got a nice reverse back, and CPI ended up under 2% for the year, and PPI ended up at under 1.5% for the year. Now, we could all argue whether CPI is really a good number. That's supposedly what it cost us to live as consumers. But it is a government number that we've used for years, that they've used for years. So if it's flawed in one way, at least it's been consistently flawed over the years as far as what the data is that we receive from the government. So for this coming year, again, not to steal the thunder at the end, we don't see a big pickup. We see these trends will kind of continue and will stay down in this low inflationary range, and that is based on a couple of factors. One of the factors is capacity utilization. The percentage of manufacturing capacity that's being utilized has kind of come up to a level that's almost pre-recessionary, but 85% of capacities cranking out and operating is about the top that you get. And right now we're sitting at about 78%. Frankly, because this is the 11/30 data, if we looked at the 12/30 data, I would guess it might be about 76% because of that issue I talked about earlier where companies were not building more inventory. They were actually depleting and selling out of inventory. That probably impacted utilization. The point about this chart, though, is nice to see is that coming out of that deep recession, we've seen a nice increase in manufacturing and capacity utilization, and it seems to be leveling off at about the 78% range. As far as the interest rate picture is concerned, look at this picture. It's very interesting. It's showing a long time horizon view of the 10-year government bond going back to 1920 and the interest that it paid back in 1920. If you look in the 40s during the Depression, that 10-year government bond was paying about 2% interest, and then it's slowly climbed up to a point in about 1975 where it really escalated. And you might remember back in those days when the interest rates were very, very high. Mortgage rates were 15%, and you thought maybe that was a pretty good yield, pretty good mortgage rate if you could get it back in those days. Ever since 1980, interest rates have been coming down. Okay. Now remember, when rates come down, that means bond prices are going up. And so we've been in a bull market bond rally since 1980. And that's an important thing to remember because a lot of people have their money invested in bonds, and we've become accustomed to, especially a bond fund, generating 7, 8, 9% returns. Well, part of the reason we were able to get such a high return in some of those bond funds is because the prices of those underlying bonds in the fund were going up as rates were coming down. If we see a reversal of this trend, that would say that the bond market bull rally is over, and what we're expecting for the most part is not necessarily a big reversal, a little bit of a trend reversal, but we'll probably just collect the interest on those bonds, 2 or 3%, maybe 4 or 5 if you have high yield bonds, but we're not going to get much growth out of those bond funds is our thought for this coming year. Okay. And interest rates move really quite a bit with what we see as the GDP picture. So this is just two overlays of GDP versus the 10-year Treasury yield. Okay, and it only goes back to 1963, so it doesn't go back as far as the other one that we just discussed. But if you look at the 10-year Treasury yield, again, the blue line, it's trending downward. And if you look at nominal GDP, year-over-year change, it's got some volatility, as you would expect, but also trending downward. So the economy is growing slower, and interest rates are lower. And if the economy starts to heat up like we had back in the 60s and the 70s, we would anticipate an increase in interest rates. But we don't see that happening right now. Not a substantial increase in interest rates, at least. Okay. So let's look at the commodities front, because remember, we thought that commodities, for the most part, were going to be weak because of global concerns and slowdown, and we got that right. We also saw oil consumption kind of flatten out this past year. So what this chart is showing is two different things. It's showing consumption in the gray bars, and you can see consumption has been trending upward on a global basis of oil since 1998. And then this is showing the crude price of oil. We had a speculative run-up in bubble in crude. Like most bubbles, that bubble burst and came down to very low levels, actually below what you would have thought would have been the resistance level of $50, came down to about $35, and has slowly been moving its way back up. You can see right now we're at about $91.82. It's actually higher now. But you can see a little bit of a trending upward out of this bubble bursting scenario of oil speculation. And we see a little bit of a flattening up here in the consumption. If we see a scenario where we do, that globally the economies start growing again, it would just be natural that we would expect some sort of increase in global oil demand. The other reason that we're seeing less upward pressure is because of supply. It wasn't that many years ago, 3 years ago, that none of us even probably knew anything about the Bakken region up in North Dakota. And now North Dakota is the second largest oil producing state in the country behind Texas and ahead of Alaska. So there's more supply coming online than we've seen in quite a long time as well. But we think overall commodity prices, oil being one of them, will start trending back upward if global growth continues. So how about gold again? Looking at that, we've showed this picture in the past. What this is showing you is that the price of gold is compared to the Dow Jones Industrial Average. And so how many ounces of gold basically do you need to buy the Dow Jones Industrial Average? Dow Jones just crossed the 14,000 mark this morning. It's 14,009 as of right now, up 148 points. So we'll see if it can continue this for the afternoon and hold up. And this chart is saying if you're going to buy the Dow Jones Industrial Average, historically, it takes 12 ounces of gold to buy the Dow Jones. That's what this green line is showing. It's right at about 12 bucks there, okay, or 12 ounces. Okay, so when you need a lot less gold to buy the Dow Jones Industrial Average, gold is cheap. And again, in a scenario like we're at right now, where gold is very expensive. So right now, it takes about 8 ounces of gold to buy the Dow Jones Industrial Average. Gold is about 50 bucks an ounce. So if you times that by 12, the average, it would tell you that the Dow Jones shouldn't be at 14,000, it should be at 19,000. So gold tends to be overvalued as compared to the Dow Jones Industrial Average and compared to stocks. This bottom chart here is just showing you gold prices, and you can see the tremendous ramp up since 2001 to these levels that they're at right now. A year ago, we were saying gold looked like it was expensive. I didn't make a call for a correction, like I had done the year before, which proved not to be the case. But we just said it looked like it was inexpensive, and that was basically the case. It came down a little bit, but nothing substantial. Excuse me, we thought it was expensive. It came down a little bit, but nothing substantial this year. And we probably don't see that happening much this coming year as well. All right, so we've covered a lot of ground here in a relatively short time. Let's talk about stock markets, and specifically the U.S. stock market. This chart, this shows a 10-year rolling period performance of the S&P 500. So these are not annual returns. These are 10-year returns. So to be clear, if you go to 1950, from 1940 to 1950, the S&P 500 for that 10-year time period had about a 0% return. Okay, so what I want you to take away from this is just the mental picture of what's going on here. We go through a cycle, it looks like. And again, where it's stock markets from 1930 to 1940 had big negative returns. You go out to 1960, you can see from 1950 to 1960, we had a nice annual rate of return of about 15% a year in the stock market. And then throughout the 70s, because of high interest rate, oil embargoes, and different policies that were in place, we saw stocks, again, underperformed. And if you go out to about almost 1980, you see a scenario where 1970 to 1980, there was no S&P performance at all. Then we see another big run-up to the point 1999, if you look at the first decade of the millennium, excuse me, the last decade of the 1900s, the average rate of return in the stock market was about 16% a year during that 10-year time period. And in the first decade of the millennium, we had pretty much no rate of return for that time period. So the good thing that we're seeing here is this trend on the right where we're starting to move upward, and we're hoping that that trend continues. But it is interesting, isn't it, looking at this over longer time periods, taking out the 1-year volatility picture by looking at 10-year rolling periods. At least I think it's interesting. Okay. And the one reason the market's been doing well recently is because earnings are up so high. We talked about that already when I was talking about the economy. But we've seen a nice run-up in earnings on the S&P 500. And this blue line represents operating earnings per share. And the estimates that are out there right now is that those earnings are going to be $113 per share. Okay. Now, this is the wild card in things. Well, if we get this, we should see a continuation in the S&P 500. Doesn't mean we will for sure, but we should. The big thing that we're going to be watching for all of you this year is are these earnings numbers, are corporate earnings coming in as strongly as the expectations? So far, the first quarter of this year, the last quarter of last year really, but the announcements that started coming in this quarter are starting to show some pretty good earnings out there. So it's very important that we keep abreast of those earnings, because generally over time stock prices do tend to follow earnings. Sometimes they get ahead of the earnings, way ahead of the earnings, like we had back in 2000. Okay, and that was caused, if you remember, by the dot-com, bubble, and the technology as a whole. Everybody wanted to own Intel, Cisco, Microsoft, those sort of companies, and they wanted to order and own all the dot-com stocks, and that bubble did obviously burst. But if you look at earnings per share versus where stock prices were back in that time, you see this huge gap. And that looks like, again, hindsight's being crystal clear, it looked like stocks were clearly overvalued, and they did correct. Okay. But then we saw a nice increase in earnings throughout, this 2000 to 2007 time period, decrease in earnings, and now we see a substantial rise. And this right here is showing that our earnings, this green line, is showing that the earnings are actually, above the index. So we still think that stocks look relatively inexpensive for this coming year because of this. And if we can get a scenario where the 2013 earnings continue to grow, then we should have a scenario where we would hope that the stock market would do well. Now, I will tell you, stock market's up 5% for the month of January. We have a nice rally here today. You have to be careful about timing into this market and timing out of it. We've had a big run up in it, and we've had it in a very short amount of time. So as good as this picture looks for earnings and for stock prices, we are taking a cautious view currently as far as timing, especially with new dollars coming into the firm. Just being cautious is what we're doing. This chart I thought was really interesting, and we spent a lot of time on it, surprisingly, to tell you the truth, at the two seminars that we've done here at our office in the conference room. This chart is overlaying three things. It's overlaying the black line, which is the S&P 500 index, and the movement in the index. Okay, so again, you see that up and down approach that we've already talked about. This is on an annual basis going back to 91. Okay, the blue bars are showing the amount of money net that's going into stock funds, and the green bars are representing the net amount of money going into bond funds. So blue are stocks and green are bonds. Here's what's interesting. Let's go back to the late 90s. .com, everybody wants to buy Intel. Everybody wants to buy all the big technology and all of the .com stocks. Okay, massive inflows of money into the stock market, mutual funds, as the stock market goes and already went up. Okay, huge amounts of money. That we haven't seen before. Okay, stock market comes down, huge amount of money flow out of it and start moving into bonds. Okay, that's a panic almost type of scenario. And then if you go through the 2000s as the stock market has increased, you can see very little participation, you know, in some of these areas, and even a little bit of a sell-off. Then when the stock market tanks again, we see a lot of selling going on, and everybody starts moving their money towards bonds. That's what all this green activity is here. It's all this bonds. So this huge movement from 2009 up to the present, money was flowing out of the stock market and flowing into bonds. And I've already covered the fact that bonds have been on a rally since 1980. So people tend to chase what did well last year, especially when they're scared or nervous about the, you know, the stock market, which, you know, rightfully so. I mean, these are big swings up and down. But it shows you a little bit of a flaw of the consumer and their strategy out there. So much so that there was a study done that said, okay, if you look at the time period of 1990s and the first decade of the millennium, that 20-year time period, the S&P 500 generated a return of approximately 9% a year through that 20-year time period. The average investor made 3%. And the reason is because of this chart. The flows, the herd is moving in one direction after the bad has already occurred. So a lot of you that are on this call, you've worked with us for a long time. We've had these discussions as far as having a strategy in place, and this is why it's crucial to have a strategy so that we don't get stuck in this fund flow herd trap by doing what everybody else is doing. So we look at valuations of the stock market. The flows are one thing, but how about stocks? Do they look like they're cheap? Do they look like they're expensive? I've already alluded to this. We think that they're relatively inexpensive, not cheap. Okay. So what this is showing you is that the top 200 companies in this country. Now, what is their PE ratio? Their price to earnings ratio. Typically, the lower the price to earnings ratio, the better valuation, the less expensive the stock is or the stock market is. Okay, and so we are trading at lower price to earning ratios as compared to an average number. Now the key here is, remember, earnings have been great, and we're hoping and expecting that they will continue to be good in 2013. If that divider changes and it's not so good, all of a sudden the PE ratio jumps up and the stock market looks like it becomes overvalued. Okay, so that's how important earnings is. It's a big part of that valuation criteria. Same thing with small company stocks. So with the small stocks, what you have here is a scenario where, I'm going to take a quick drink. With the small stocks, you have a lot of blue that's underneath that green line as well. And so you end up with, again, small stocks look like they're relatively inexpensive, but not as much as large company stocks potentially. So how about fixed income? You know, in particular the valuations. If interest rates have kind of stopped going down, are there any values out there in the fixed income or bond market arena? And one of them is thank you. Somebody just gave me some water so I can talk a little more clearly. One of them is the spread on interest rates. So if we just look at the spreads of bonds between AAA and BBB rated bonds, the spread's narrowed. So that's basically saying, you know, from a credit quality standpoint, everything has kind of moved back to a normal range. And the credit crisis that we had with the stock market coming down back in 2008, 2009, everybody was worried about lower grade bonds being able to pay their interest. Well, that's subsided. And right now there's not a huge difference between the spreads between BBB bonds and AAA bonds. There's some. It's a normal spread though. Okay. Same thing with high yield bonds. So if you go into the junk bond market to try to get the better yields, you know, you would have got a substantial amount of more or additional interest back in 2008. And those spreads have come down again to a normal range. You should get higher rates for junk because you're taking on more risk as an investor. It's just, About a 500 basis points or 5% range is normal, not 2,000 basis points or 20% additional risk. But back then we were having it. Where there might be some value, especially with a scenario we're going to talk about here in a minute, but taxes going up, is in the municipal bond market. Again, you wouldn't use this in an IRA account, of course, but muni bonds grow state and federal tax-free, and they're backed by the full faith and credit of the municipality. So there's risk there, of course, but they're all ranked, and you can kind of pick and choose how much risk you want to take, at least on the onset with these bonds. But the green and the blue line just represents yields on bonds on a corporate basis versus a muni basis. So the taxable equivalent yield of a tax-free bond, if you're in the 35% federal bracket, is still higher than the taxable yield of a corporate bond. So while they've trended downward and they're nowhere near their spike, that's again back here in the credit crisis. Everybody was worried that every home was going to be foreclosed on. I'm being a little sarcastic here. And everybody was going to stop paying their property taxes, and therefore municipalities were no longer going to be able to pay their interest on these bonds, to kind of a more normal return. But you can see still pretty low rates. And again, that's just what we're going to be stuck with this probably coming year, are low rates. On the international front, finally, the balance sheet of the European Central Bank is flattening out. This is all the buying that they had to do of Greek bonds and Spain bonds and Italian bonds to try to stabilize those economies and those prices. That looks like that bailout, if you will, of some of these countries has at least stopped increasing and is flattening at this piece. There's still a concern. We still got all these bonds and a big push up, but that's overall good for the region and good for the zone. And the one reason we like the international markets they'll talk about here is because of that feature and because of their price to earnings ratio. A lot of the international markets, especially the United Kingdom and Germany, are trading at pretty cheap prices as compared to other parts of the world. Japan, who had a 25% run-up almost in their stock market in the last quarter of the year, are trading at a pretty high multiple right now. That means, again, going back to that chart from a little while ago, it means valuations tend to be a little bit high. So if you look at the United Kingdom and you look at Germany, they tend to be cheaper than the United States, and they tend to be cheaper than some of the other developed markets out there. How about the emerging markets? What's going on there? The emerging markets, some of them look even cheaper than our market or some of the more developed, mature European markets. China specifically looks like, for the next 12 months is going to have a PE ratio in the 10 range, which looks relatively inexpensive for an economy that should grow in the 6%, maybe 7% range, maybe 5, somewhere in that band. But even if they grow at 6, that's 3 times the growth rate of the economy than what we're expecting here in the United States. This middle one bar in here is Brazil. Brazil had a tough year last year as far as stocks are concerned, but look relatively inexpensive. India is the only emerging market that looks kind of expensive as compared to these other ones. There's a whole host of them that we could put up there, South Africa and the countries within Africa, but these are the major ones that most people look at. And we like what we see in the emerging markets front. While they're volatile and they might not be appropriate for everybody on this call, your advisor probably will be talking to you, if they haven't already, about that emerging markets. We also see something going on about consumer confidence that we think might bode well for what's going on in Europe. Consumer confidence is a trailing indicator of what's going on in the economy. Consumers don't become confident until things start to improve. And therefore, they wait around for that improvement before they feel good about themselves and about spending. So right now, over in Europe, business confidence and consumer confidence is pretty low. And we think that will continue. Well, we think that's going to trend upward, and the consumer confidence will get better as these economies kind of pull out of their funk and start moving again this coming year. So I know I've covered a lot, so let's see if I can summarize it all on here for you, because we told you this call would last about an hour aside from our technical difficulties. The fragile economy will continue. This economy is going to grow slowly. There is no catalyst out there for a robust economy that we see. We don't have a technology catalyst like we did back in the 90s. We're looking for 2 to 2.5, maybe at the high end 3% growth from the U.S. economy. And that's despite, Congress not being able to seem to get anything done regarding the fiscal cliff, true spending cuts, or a true tax plan. Okay. Inflation is going to remain low. It's always a concern of ours, because if for some reason we did see a pickup in inflation, a lot of these other things that we're talking about kind of fall aside. But for this coming year, again, we don't see a catalyst that would push up pricing, especially if you look at the oil commodities. We'll see a little bit of push up because of global growth demands, but there's a lot of supply coming online as well. Commodities overall, because of that global growth, we do think we'll have some appeal, and we think there's room in portfolios for that, again, for the right situation and the right person. But if commodities are stronger, it's going to be because of, we're going to be right about this global growth component that we've been talking about. Housing improves. I think I've already made that clear. And there's just higher confidence in the housing market. We still have a generation. It'll be interesting to see how this plays out. But we have a generation, the younger generation, that don't really believe in housing because they've seen what's occurred the last 10 years. So as those people do, mature in their life and they build families, they're still going to need housing. And we think overall housing starts to improve this year. Nowhere near what we had in 2005 and 6, but nevertheless, slight improvement upward. We're also going to see a slight upward trend in interest rates, nothing substantial, but we think we hit the low on the 10-year government bond of 1.6% already, and we're a little bit above 2% as of yesterday with rates there. So, and it's 2.01 as of right now. I just looked it up. U.S. stocks still look relatively inexpensive, but like I've already said, we need to watch earnings closely. And we do need to watch, on a short-term basis, the opportunities to get in and get out of the market as we measure relative strength and some other indicators here at the office to try to make some tactical changes. But if you look at it on a one-year basis and you look at earnings, we think stocks are still a good opportunity for this coming year. In emerging market stocks, I think even look better, but there is a risk-reward relationship there that you just have to be careful with. And taxes are going up. Okay, so that might be good if you own municipal bonds, but it's just something from a planning perspective we need to keep in mind. Capital gain rates are going up for higher income earners. That's been passed. The FICA tax for everybody who's working has gone back up to where it was a couple of years ago. If you might recall, it was temporarily at the employer level decreased, and not on the employee level, just on the employer level, and now that's been reversed. So we're seeing that. We also, because we live in the great state of Minnesota, I think everybody in this call is calling in from Minnesota. We also have seen, Governor Dayton talking about increasing taxes at certain levels, especially at the high income level earner, going from 8% to 9.7%, I think is the number. So planning for this increase in taxes is something that's going to be important this coming year, which takes me to my last bullet point, which is always my last bullet point, is just make sure that we're very careful with what's going on in this world and in these markets, and continue to stay focused on what's important to you and what's important to your strategy and your goal as you work with your advisors. So next year at this time, we'll go through these bullet points and we'll see if we got them right. On behalf of all the advisors here at 360 Financial, I'd like to thank you for listening in on the phone call and this webinar. I hope you found this educational hour well worth your time and some and you receive some benefit from this. As always, we're really thankful and sincerely happy to have you as clients. If you're not a client and you're on this phone, we'd love to have you as a client. And I think this will give you a good idea of the things that we're thinking of for this coming year. So yeah, these are disclosures and definitions. So you need to read those quickly. If you really want to look at them, you can go to our website and you can look at all of those as well. So I am done. Janet, do you want to either open up the microphones for questions, or do we have any questions that have come on?
I just wanted to say, first of all, I apologize for the technical errors. Hopefully we won't have that occur again. We do have the lines and computer microphones. Everything is open. Everybody is unmuted. So I did not receive any questions through the chat feature. So if anyone has a question, now is a great time. Go ahead.
So we either did a great job going through all this, or it confused you all so much that you don't know what to ask.
Well, I'll just mention
we're obviously
that
available. I was just saying we're obviously available with any questions that you have, and maybe that's why we don't have questions. So you can get a hold of us, and we can help you out anytime that you have questions.
And I just wanted to mention that we hope to have this recording. We did record the presentation, and we hope to have that on our website. Not quite sure exactly when we'll have that up and running, but we hope to have that in the next couple of days. So again, we thank you for attending, and let us know if you have any questions. Thank you.
Goodbye. Thanks again.